Hey guys, welcome back to the latest edition of Elevate Career Academy podcast. Today, I'm super excited to have on our guest, who is an investor at KKR, one of the largest and most prominent private equity firms in the world. Prior to that, he started his career at Goldman Sachs on the distressed credit side. Today's discussion is really going to focus a lot on private investing and also credit, debt, and investing. It's a great area to learn about, especially in these times, and really insightful for anyone who's interested in private investing, credit, and really how deals come together. We talk about a range of different topics, right? And here are some highlights. First, what is the role of an associate or principal at KKR? Specifically, what are the types of modeling, analyses, and work that you're doing? What types of work do you do on a day-to-day basis? And how do you think about risk protection downside on the deals that you work on? And more broadly, how does one become a better investor in that context? We also spend time on how he entered his finance career from a non-target school into Goldman Sachs. In fact, he didn't get an interview at Goldman at first, but somehow he got creative to land that job. We go into the differences between public and private investing and the types of people that are, from his experience, successful in one or the other. We also spend some time on how you can use your early career experiences, whether it's internships or jobs, to find out what you're really good at and interested in, and things that you're not good at or maybe less interested in, and that really forms how successful you can be early on in your career. We talk about the current markets, what's going on in the deal space, leverage, credit, transactions, and how that's being impacted by what's going on around the world. We also take a short-term, medium-term, and long-term view. I also spend some time on how Corona is going to affect deals and companies and businesses going forward. Then we touch on advice, tangible advice that we can give and he can give to students and young professionals. And the general takeaway is, look, it's going to be tough, but kind of focusing on building skills and really setting yourself for success for your career is going to be really important. One of my favorite parts of this whole conversation is when he goes into his favorite deal experience at KKR, and it kind of feels like a behind the scenes to like a Suits episode. So I think you guys really enjoy that. As always, I'm excited to bring this and other conversations like this to our audience. Be sure to check out all of the really great resources that we have like this from top professionals in top careers and at top firms on our website at elevatelab.org. Link below. And now we're on Instagram and LinkedIn also, links below as well. If you're listening, I ask that you subscribe and share with others and really spread the knowledge and the network. So now let's get to it and hope you guys enjoy the discussion. Hey guys, welcome back to another edition of Elevate Career Discussions. Really great to have you here. Thanks for joining us. Maybe you could give folks just a quick overview of your background, kind of what you've done and what you do now.
Yeah, happy to do so. I went to school at University of Maryland, graduated about 5 years ago. Out of that, I went to Goldman for 2 years in a distressed credit desk analyst seat. Was there for 2 years. And then after that, went to KKR, and I've been there for the past 3 years in a private credit seat. What I was doing at Goldman was more public side, and now I'm more private side investing. And on a day-to-day basis, we're helping finance different companies that, for a lot of different reasons, can't go to banks in most cases. And so they're looking for some type of attractive covenant package, attractive, rate features. It could be, PIK toggle. It can be, mezzanine financing. For one or any other reasons, size, distressed, et cetera, these are companies that generally can't go to banks, and they end up with us usually for some creative reason. And we can certainly do normal lending through banks as well, but we're just not as competitive in that process. And so day to day, I've got around 20 portfolio companies, and then also looking at new opportunities for financing as needed.
Maybe right off the bat, you can kind of share a couple pieces of advice I think you've gained over your career based on your experience and kind of how your career ends up playing out, and what maybe you wish you'd know.
Yeah, sure. So just being totally candid, I had no idea it was going to play out this way, and definitely not when I was in college. And so I think some of the best things to do early on are to just try as many different things as possible. So that's the first thing I say. Just try as many different things. One of the things I was just lucky in Maryland is that a lot of the business school classes were Tuesday, Thursday only. So I was able to do a lot of internships Monday, Wednesday, Friday, whether it was locally or in DC. And so I did a bunch of random stuff where like there was a semester where I was like working for Aflac with like insurance sales, which was miserable. And then I was doing like private wealth somewhere and asset management somewhere else. And doing a lot of those different internships kind of showed me what I wanted to not do more than showing me, oh yeah, do this thing. It was really good to just meet a lot of people and learn like what I didn't want to do. And I also just pick up skill sets along the way. So that I think is one thing, just have an open mind and like try as many things as possible. You're not really going to be able to do that after graduating as much, but you still can. The other thing I'd broadly say is like, it's related to the first thing, but like when you find something that you're doing, just it's worked for me and it's kind of how I thought about it. Just commit to it for a set period of time. I think we kind of live in a scenario today where no one wants to commit to like one job or one thing, and a lot of different roles. And so it's hard to think like, oh well, I could go be doing PE at Blackstone, or I could be at Greenlight, or I could be doing some entrepreneurial thing. And if you're always thinking about that, you're never really going to be present and getting the most out of what you're doing in that moment. And so I think it was what was really helpful for me. Not that I knew all this when I was doing it, but when I, was doing a lot of these internships, I hadn't mapped it out. I wasn't like, oh, I'm going to do these 6 internships and then going to end up at Goldman Sachs. Like, no, it just one internship led to the next. And then that internship led to the next one. And there was, points where when I first started like my wealth management internship, I was really bad at it. I had to do a lot of like, reports for like financial analytics. And I wasn't good at it. Like I made a lot of mistakes, but over time I got better at like literal attention to detail type things. And then I was like, well, I probably don't want to be doing something like this. So then I ended up going to an economic research firm, which is a lot more intellectually stimulating. And so just trying a lot of things and saying for this period of time, I'm going to commit to this. And 9 months in, you're going to, get a bunch of headhunters being like, why don't you go to PE right now? And that's great. You can do that. At the same time, you're going to get a lot out of it if for some period of time you say like, even if I'm going to go to PE, like I'm really going to buckle in here and try to stay committed, do everything I can. And if you really kind of commit to that thing, once like, okay, now I'm going to go to PE, you'll have a lot more to show for having done that.
That's awesome. I love that advice. Keep an open mind, explore a lot of stuff, and then live in the moment and learn as much as you can. I think that was excellent. Maybe we could start with your kind of Goldman Sachs experience. Maybe talk a little bit about your journey into, Goldman. What are the types of things you hinted to it a little bit. How did you get that job coming from a non-target school? What can you share from that journey?
Yeah, definitely. And so really candid, I didn't get an interview at first. Maryland had like a few interview spots and I actually didn't get it. What I had done the past few years, I'd done, as I was saying, like a bunch of different internships. And I'd obviously done like the networking that everyone does these days, which is spammed LinkedIn really hard. And talked to like as many alums as possible. I'd snuck into like the Wharton and MIT career fairs, like things that everyone is doing these days. Maybe people were doing them back then too, but I feel like it's way more competitive now. And I didn't get the offer, or I didn't even get an interview. What I ended up doing is I went to Citi and I got an interview and offer at Citi. And then I went to JP Morgan. I got an interview and offer at JP Morgan. And then I called Goldman back and I said, hey, I have these offers at JP and Citi. Is there something that can be done here? And that's how I actually got the interview at Goldman. Once I got the interview, this was for a more rotational program. And so I got the interview, got the offer, summer there, did 3 different rotations in principal funding and investment, which is more of a structured credit lending investing type seat. Commodities, which was just pure commodities trading. Now, Goldman used to do a lot of prop in that, but they don't anymore. And then the special assets group, which is where I ended up joining full-time, which was more of a distressed credit desk analyst seat, where Goldman has this large book of stressed loans, and that needs to be managed in a more fundamental buy-side research analyst role. So you had these similar work stream in that of a sell-side research analyst, in that you had to build models, understand companies, talk to management, do a lot of work. But then you also had the buy-side kind of asset management seat, in that you had to actually manage your book of loans. And there was going to be other trades that were going to be put on, whether it's bonds, loans, put options, CDS, what have you, for various purposes, hedging, whatnot. And so having tried, I feel like, for the Goldman experience, and more in line with your question, I had just kind of tried a lot of different things, both at Maryland and even at Goldman, like having 3 different rotations. I kind of felt I wanted to do something that was more on the buy side. I like the idea of having risk on. And I think when you kind of have some skin in the game, you're willing to do a little bit more and you'll learn more from doing that. And so that final group was the one that I think was the good fit for me. And I ended up kind of doing that for 2 years, and if helpful, I can kind of talk to like what exactly I was doing, my takeaways.
Yeah, that would be great. That would be great.
Okay, great. So again, I sucked at it. And so for 2 years, I was in a public credit type heat where we're looking at public credit markets, looking at loans and bonds, CDS and put options, and we were trying to basically manage this book of loans, make sure that the firm didn't lose any money on the loans we had outstanding, and at the same time, if there's any discretionary hedges that add P&L, maybe you have a good CDS trade, what have you, that goes great. And so on a day-to-day basis, I was probably covering anywhere from 20 to 30 names where I was building out models, getting on the phone with management, listening to earnings calls, analyzing credit, looking at credit agreements, and figuring out whether I liked where the credits were trading or not. And if I did like where the credits were trading, is there something to do there in terms of putting on some trade or otherwise? And whether it's long-term, short-term, whatever. And I remember my first pitch was a short, which went fine. It was really good. We went short. It was a good trade. Made more than like $1 million in P&L. I remember that like very personally. It was a small trade, but it was like bonds dropped by like 20 points, and like it was well timed. It was like bond shorts are hard to make money on, and like that all went well. And then after that, like there was just a plethora of like CDS bad bets and just a ton of stuff where it's like, oh, I think these retailers are doing bad. Like, just kidding, credit markets are going to rip. And what I quickly came to realize is that like whenever I had done something well, like I thought I was just like getting lucky. I was fine at like making models, like great, right? I knew how to read an earnings transcript, but like so does everybody. But whenever we had lost money with something, it was very tough for me to see like what caused us to lose money and what that feedback loop was in public markets. Now, some guys like Sam Axe are amazing at that, and that's just not something I wanted to do. And I think one of the things, a good piece of advice I kind of picked up in this time frame was any job you pick is going to suck at some point. Like there's no like perfect job. There's no like, this is going to be perfect all the time. Like rainbows and pots of gold everywhere. So you kind of have to pick like, what flavor of shit sandwich are you willing to eat? Like something's going to be bad sometime. And the one that I realized I didn't want to eat was not knowing why I was wrong when I was wrong. That's what was happening a lot in public markets. And you need the risk appetite to kind of like be okay with that. And like some people are great with it. And I was like, not for me. Like I want to be able to point to stuff and be like, oh, I did that wrong. Next time I'll do that better. But there are a lot of times in the public markets where like the stock trades down, you have no clue why. Like CDS widens, you have no clue why. And you can point to some stuff that's like, you forgot to read the earnings transcript. But like, that's not exactly the case. At a certain point, you know how to read, you know how to model. You need to pick like, what are you going to be bad at? Like, what's the bad thing you want to pick? And if you can always deal with that, great. So at a certain point, I wanted to try something more on the private side of investing, particularly when there was something where I had more control over, whether it was a deal, some operational work, something where I wasn't you're always like at the whim of like luck and, things you don't expect. That's always happening, but something where at least on a day-to-day basis, I felt like I was moving the ball on my own, not putting on a trade and waiting for the market to react.
So what do you think does, and we'll talk about your private experience in a second, but you cited people that are good at public stuff. What do you think, just based on what you've seen, you may not have liked it, but what are the people that are good at public investing? What do you think they do better than others?
So I think it's a lot of, in hindsight, I think it's a lot of being okay with getting things wrong and then structuring your bets so they make sense in a path dependent world. And that was like non-English answer. So let me try to break it down. Like, it's like, you can't take like it's like black swan risk kind of, but like you can't take risks that are going to like wipe out your whole capital. So I think a lot of people that do a good job or understand that like they're going to be wrong at times, and they know they realize they won't know why they're wrong. They get that, but they're going to structure the bets and size their bets such that even if they're wrong in some places, they should be right in other places. And their overall goal isn't to be right, it's to make money. And so when you recognize that you don't want any one bet to blow up the whole house on a long-term capital management, you start looking at your investing in public markets from a more portfolio perspective. If you've read Fooled by Randomness by Nassim Taleb, I think that's a great book. And I think there are a lot of people that are fooled by randomness. I do think there are a lot of people that are in public market and they're like, man, I'm so good at public market investment. I'm like, maybe, like, or you were just, an amazing hedge fund manager from 1985 to 2005 when there was no internet for like half the population. Markets are super inefficient. And you had a plane to go watch when like the trucks were coming in, or like, you had some advantage there where you were like very lucky. And like, again, I'd rather be lucky than good. Like there's a lot of luck in that stuff. But I think the people who do it really well, to the earlier point, they structure the bets so that no one bet is going to take you out. And it's a lot of just staying alive until you get a good opportunity.
That's super helpful. I want to ask you a few questions around kind of recruiting, networking. So we'll come back to that actually. I want to kind of transition, since we're on the roll here on the investing side, maybe now transition to kind of what you do now. And on the private side, maybe give people an idea of the key differences and what you do now.
Yeah. So before, I was looking at names and I was waiting for like quarterly earnings to come out, or like credit card data or certain data to be like, how can I update my model and what's my view on where the credit is trading and why is it trading that way? What capacity does the firm have to like actually put on more debt or less debt? Or can they pay out dividends with the existing cash? And what does that mean for the underlying securities? Now my job is a lot more structuring those deals to begin with. And so a lot of times we have companies come in that don't have publicly traded credit, but for one reason or another, they can't refinance where they need debt. It can be for refi, it can be for M&A, it can be for dividend recap. And they'll come to us and say, here's our business, here's our credit. What are you willing to lend to us at? And so we start from a lot more the ground up, where you have to actually develop the model for the company. You have to make your DD list, and you're going to be like, well, here's the things I need to know. And you can kind of pick for whatever you want. Be like, here, I need to like know these things and I need this historical data, and they'll provide that to you. And you incorporate all that in coming up with a leverage read and coming up with the pricing read. So rather than saying like, oh, the bond in the public market is trading at like a 10% yield, and here's what my model says, and here's what I think it could be valued. It's more like, well, if you give me this information, I might be able to give you 4 times leverage at L plus 700. And in that process, you're also structuring the docs. You're also structuring, and by docs, I mean the credit agreement, and what are all, the levers that a company can have to lever itself up, the dividends it can pay out, things like that. And so don't get me wrong, it's still super competitive because a lot of people are trying to do this. And when capital is cheap, you really don't have as much a competitive advantage either. Your competitive advantage a lot of times is being cheap, or being at a very big shop where you can do $500 million in a single deal. That will frequently win you a deal. If someone can come to you and say, yeah, I can put $600 million and do the entire deal for you. But the job in my view on a day-to-day basis was a lot more keeping the trains running, a lot more like blocking and tackling, a lot more structuring a deal. And so I liked that aspect more than kind of waiting to see what happens in the market.
That makes sense. And then kind of maybe talk a little bit about the role, as in you alluded to this towards the end, kind of role as in senior associate, et cetera, going into principal, kind of that level when you're senior enough where you're asked to run the deal, but also responsible for all the analytics and kind of how you split your day up, in terms of the deal itself.
That's a great question. Yeah. When you start out as an associate, and it's going to vary firm by firm, but as an associate, you're kind of responsible for like all the modeling and like the vast majority of the memo. What I would say, at least at our firm, is that once you start to hit that more senior associate principal type of seat, 2 things happen. One, you'll have like a junior person under you at certain points of time where they're going to be doing a lot more of the modeling, and you'll still be involved as needed, but you'll have that resource. But 2, you have to be able to come up out of that modeling, and it becomes very quickly a sales job. Like you need to quickly distill everything in the modeling and the PowerPoint, and to be able to like really sell the idea to the investment committee quickly. You can't sit there and talk about like just the whole jargon of things. You need to be like, this is the deal, these are the terms, ABC, it's good, risk mitigant, whatever. And it very quickly turns from a technical focused job to more of like an EQ, more of a sales role. Not in that you're going out and selling ideas, but you're selling them internally. And there's that quote. It's like at the end of the day, like everything is sales, and like couldn't be more true. It's ironic because when I was at Aflac, right, one of my first internships, I was like, I don't like selling insurance. Like, I don't want to sell like this sucks. Like I'm calling people and trying to sell them something. And now like I'm selling people paper every day. I like to pretend like I'm Jim from The Office. It's just, George Washington and Ben Franklin on the piece of paper. And it's money. And so it's like, well, this paper costs helpful 700, take it or leave it. But that's, it really comes down to how quickly and well can you sell ideas? How quickly can you, convince somebody that you've got a good idea that's also good for them. You have to do all the work to back that up.
No, that makes sense. And maybe talk about kind of putting on that investor's mindset. You talked about, you've done it on the public side, private side. Kind of what do you think makes good investor? How can people build those skills early in their career? And then, what are some of the like good things, and also what are the pitfalls of that seat?
Yeah. So I have maybe a bit of an unorthodox view on this, but I think one of the best things you can actually do is go try a bunch of things outside of finance and like go talk to a lot of people, do a lot of like different things that'll just like teach you like how the world works. I think there's a quote I like that's like, a desk is a very dangerous place from which to view the world. And I see a lot of analysts and a lot of associates that are like, yeah, well, I am just so good at LBO modeling and reading these sims. And like, I know like what the right investment theses are to sell it to my IC. And like, that may be true, but like, in my view, like there's a lot of fooled by randomness there. There's a lot of like things have worked that way because they always work that way. And then when they don't work, you're kind of caught off balance. And I think the things that really helped me. So one thing I did is, maybe we spoke about this earlier, but I started doing like some of the real estate investing with one of my buddies right when I was finishing up Goldman. And so we had bought, and I think the point is like we had boots on the ground, like we actually had to operate the business. And like having to go to a different state, a different city that I had never been in before, and just like put your boots on the ground, like don't sit behind a desk and go try to like build and run that business. You will learn so much. Like way more than like reading a bunch of sims. And it was everything from like, well, we need to buy all historical Airbnb data and then we need to sift through it. That's probably what like most analysts could crush. Like you're probably going to have everyone who, if you're listening to this, you can probably do a really good sort function in Excel to tell you like what zip codes to invest in. But then you actually have to go there. You have to like find the right home. You have to like tour the properties. You have to meet the agents and like convince them to like give you their time because you're some 22-year-old guy who thinks he can make a buck in their community. Buy the property, actually fix up the property, right? Like we did everything from painting doors. We went on Facebook because the Savannah College of Art and Design was really close by. And like those kids are probably better at interior design than I'll ever be. And like hire somebody, right? And then you have to go find someone to take care of the property. And like literally doing all of this taught me way more than like reading 10Ks. And like as an example, the first night we decided to stay in our property, and turns out the person who used to stay in that property was a big smoker, and all the smoke came out of the HVAC system. And on day one, we had to spend another 10 grand in like replacing part of the HVAC. So it very quickly became like, wow, like how unlucky was that? Like, wow, we messed that up. And it quickly helps you see how lucky you've been for so many times you're reading a 10K or going through a sim and things work out. There's a lot of unknown unknowns that have, I've just taken for granted. And like messing things up and messing them up in the real world, like you'll learn a lot from doing that. And having the ability to empathize with different types of people and see the shared experience that they are going through, even if you don't have to like live it for a long term, just seeing that will actually broaden your mindset. And so when you're actually thinking of investing in a business, you'll really be able to put yourself in the seat of like, a consumer, but also be like, what can really go wrong here? Because if you're sitting behind a desk, you're never really going to know what's going to go wrong. You got to make a lot of mistakes.
I like really like that answer. On the point on operating, I totally agree. I think in private equity investing, we all see this is just the operation part is the hardest part to actually deconstruct in your mind and figure out where things are going on. Because you're right, anyone can do a model and then figure out what the IRR is going to be. Maybe on that note, talk a little, since you work on the credit side, maybe I want to get on to a little bit more technical points. One is around like the types of analyses and like how you actually underwrite a deal, like what's important to you as a credit investor. And then I want to get to kind of what are some of the downside protections how do you think about downside and downside protection?
Yeah. So on the first point, look, a lot of the operating models we build aren't crazy. They're going to be similar to what you see. We're not building some super complicated LBO that's above and beyond what other firms do or anything like that. We'll model the same as everybody else. We'll have 3-statement models. We'll look at EBITDA to like true free cash flow, look at leverage, look at fixed charge covenant ratios, and just see like, what are we getting paid to take this risk? It's 5 times levered loan. Like, what's the right leverage for that? What's the right pricing for that? And we'll look at things like that. And there's like some funny rules of thumb historically that have been like, that are not true, but they're like, you don't want coupon below leverage. Like, I'm not saying that's always true, but if you're doing an L plus 500 loan at like 7 times leverage, like that might not be accurate unless you're funding like Apple. And so that's like high level. The modeling is like super easy. What I think you need to be more cognizant of is what you brought up, like your downside cases and what can go wrong. I mean, like, I think it's really easy to just model a downside case and be like, yeah, it's going to be a recession, and that means it's going to fall. Top line will fall by like 10 or 15%, and then we will and we'll have like 3 times operating leverage, but there'll still be value through the first lien, and so we're good. Like, that's like a very high level how someone might do a downside case. But I think what you really have to think through are examples. And again, like this you really start to learn this more after you like mess it up or after something goes wrong. But scenarios where it's like what's the next shoe to drop is like a question you might hear a lot. But there's scenarios where your entire business could disappear or be in trouble. An example of this is, let's say a recession does occur, or let's say there is something bad that happens and revenues fall by 20%. One thing that can happen is you can get downgraded by the rating agencies. And if you get downgraded by the rating agencies, it happens frequently, like people are like, okay, then the debt should be more expensive. But a real world effect of that is that there is a big press release that goes out on all the news sites that says like ABC Co is downgraded. And when customers see that, they might get scared and say, oh, well, if you're on selective default now, should I still keep my business with you? Next thing you know, all your customers are pulling their business out, and you have to be aware that you could go from a business that does $1 billion in revenue very quickly to 400 million if the customers are scared. So you need real retention and real contract structure on something that you thought was just like, okay, maybe it's just down 10, 20% in a downside. And like, this kind of stuff is more on the operational front than what you will get from just sitting behind a desk and like modeling it out. And so how do you protect against that? You need to have like, it's not as simple as like having a covenant. Like, you need to be involved with management, right? I mean, at KKR, we do have capstone when they're like going to be operationally involved, but there are scenarios where we're intimately involved with management. There are scenarios where, we've done like customer calls and like been involved with those to like voice our support for the deal and the company. And there've been a lot of scenarios where you need to, we'll call up the rating agencies, and we have to be actively playing offense to make sure that the worst downside case doesn't occur. You can structure the deal all you want. Like, you can, have your covenant, you can have a good amortization structure, you can have an ECF sweep, you can have a tight EBITDA definition, but like, just be realistic. Like, if all the customers or 80% of the customers leave because you got put on selective default, covenant trips, and you take over the business, then what? Like, you're going to have like a big old, like, 0.4 MOIC, and you're going to have to mark it off that for your, fund 8. That's not going to work. And so the downside case isn't so much a modeling exercise, so much as what are you actually going to do? And a problem there is that you frequently will not have the bandwidth to do it. And so you're going to have to really pick your spots, and you need to pick businesses where you don't have that high standard deviation downside.
Yeah, that's helpful. I think, one of the biggest lessons learned from investing, I would comment on the last thing, is you spot on. You don't want to be in a position where you're spending more time fixing bad deals. It's better to just not do a deal.
Yeah.
More
don't do bad deals.
Can we just, maybe for the people who are not as aware, kind of, maybe can you just do like a quick 101 on some of the structural things that you alluded to? Like how would you do covenants, or how would you, do the pricing structure, the cash, sweeps and things like that maybe people can learn from?
Yeah, so I think examples and how I think about it is you can set covenants, which basically means when you fund a deal, you're going to be a certain times levered. That means if you have 200 of debt and 50 of EBITDA, you're 4 times levered. You will set covenants at a certain cushion to that opening 4 times leverage. So we might say a 50% covenant. That would be very wide, but a 50% covenant means if EBITDA falls by 50%, so if it falls from 40 to 20, whatever leverage ratio that is, that's a covenant. After that, if that covenant trips, you have the ability to, if you really want to, you can take over the company, you as a creditor. And so usually you don't take over the company. There's some like give and take. The company pays you a fee. They widen the covenants. They probably come to you proactively. There's a lot of things that happen, but it's a way for you as a creditor to step into the business. That's like one thing that you will want on your deals and covenant. Another thing is called amortization, which is similar to buying a home. If you have 5% amortization, let's say on a $200 million loan, in year one, the borrower will have to pay 10 million of amort. So 200 goes to 190. In year two, they have to pay another 10 million. So 190 goes to 180, etc. And so it keeps going like that. And that's a way for you to de-risk and get your dollars back. The final thing that I mentioned is called an ECF sweep, and that stands for excess cash flow sweep, which is basically whatever excess cash flow the borrower generates in any given year, they have to pay a percentage of that to pay off the existing debt. So if you had a $200 million loan and the company makes 50 million of excess cash flow, you might have recourse to 50% of that. So 50% of 50 is 25, and they have to pay that $25 million off the 200. So then there's 175 of debt outstanding. ECF sweeps almost never get hit. And by that, I mean the structure of the legal docs is written such that there's so many like loopholes and carve outs that you never really get. I've never been paid an ECF sweep. I've never received dollars from an ECF sweep.
Got it. That's super helpful. Kind of a quick sales pitch on KKR as a whole, as well as your kind of your part of the firm.
Yeah, sure. I think there's a few things I put. One is just like responsibility. It's like super lean. I'm frequently on 2, maybe 3-person deal teams. And so even when I came in, like I was going to a lot of management meetings with CEOs and CFOs by myself. I had to like go, just run different process of deals on my own. Sometimes, there's calls with lawyers where there's like some senior partner at a law firm and I just have to like get on the phone and like deal with it and like figure it all out. And so I think the responsibility to lean firm is huge, like KKR. The second thing I'd point to that really differentiates KKR is the capital markets arm. And so that's something KKR has built out in the past few years that's actually been like a pretty good threat on the street in terms of just earning overall fees. But you have our own cap markets arm that can help syndicate debt deals and equity deals. The benefit of that is that when I want to talk to somebody or I need a relationship or I want to talk to somebody at different funds, there's a very easy way for me to go do that and gauge where the street is on like how credit markets are. And specifically, it can be scenarios where we're in a private credit and then we want to syndicate that deal and then take it public because it's the company is growing, their cost of capital is not as expensive as it is it more expensive today than it will be in the future. And so because of that, it won't fit in our pools of capital, but we can still retain and earn the fees on helping place that debt. And so that standpoint, not only do I have to like know all of my credit metrics and why I like this credit, but then I can speak to the credit analyst at Blackstone or at like Carlyle, or I can go talk about these things and I can gauge the health of the street overall. I think that's actually a pretty good way to like just have a good network broadly. Those are like the two, I think like the really big things. And then I would say like, we don't really care as much about FaceTime. Like, are you busy? Absolutely, yes. But like, there's not like a just sit there, do nothing.
You kind of think about kind of like a large buyout fund. There's kind of a lot of deal flow, right? That's obviously a positive. Can I maybe talk a little bit about, working with particular portfolio companies or kind of the operations? Kind of how would you think about structuring your day amongst like sourcing, execution work, and then like, operational stuff? Maybe talk about the dynamics behind those 3 parts of investing.
Yeah, so what I'd say is that the junior associate and even the senior associate-ish, and we just have associates, mind you, as a title, you're not really sourcing much at all, almost none. And if you happen to source, awesome, but none. So most of my day historically has been spent, I'd section 1, I'd say when you start, like I would say 60 to 80 or even 90% of your day is spent like modeling and memo creation and like making DD lists and like hopping on the phone with management, talk through that. You're really in the underwriting process. You're really in this, and that's like 60 to 90% of your day, call it, as like, when you first start. And then the other 10% is like some amount of like presenting at committees or like selling your ideas, and then kind of making sure that the trains run on time, getting back leverage to work, just making sure everything is smooth for the portfolio front. As you progress though, and as you get more senior, once you've been there for a few years, you're going to do a lot more what I would term as deal championing. So someone will probably be running the model and everything, and it could still be you, but I would say it almost goes to like 60% the other way, where your job is, having your quick bullet points ready and being able to sell this idea to your MD, to your committee, to external leverage parties, to any co-investors. And so being able to like sell the idea and have like a really good way. And really what you're doing is just running around deal championing. And if you're on specific deals, there are scenarios where you might get more operationally involved and you're going to be working with Capstone, or you're going to be on like some weird side project where you need to have a little more operational understanding. And so that's the exception, not the rule. I'd say at this point, like there's probably like, I'm on one deal where it's a little more operationally heavy, but I would say maybe 30 to 40% of my time is spent on like new deal, like, or maybe 40 to 50% of my time is like new deal, like memos and modeling. And then another 40% of my time is like existing portfolio business and like diligence on that, but also just like monitoring management meetings, board meetings, staying on top of those things. And that probably includes a lot of the operational work, which is why it gets up to like 40%. And then the remaining kind of 20%, if it's anything, is there's a bunch of just like other stuff that just, the day goes on. And if you're not underwriting deals, you're not monitoring deals, you still have to make sure the portfolio is running. A lot of BDC type stuff where you have to make sure your leverage facilities are working. You have to help provide the diligence angles to the leverage facility so they keep lending to you, a bunch of things like that.
Got it. That's very helpful. I want to spend a couple of minutes on the current environment, interesting things you're seeing and kind of coming into this kind of crisis mode, and then maybe your outlook for investing in general, kind of, what you think, no one really knows, but how you are thinking about the world.
Yeah. So this environment, I'd say a few things. Like, so capital has become very expensive. And so the uni market, what may have been, an L550 to L550, L600 standard unit tranche, any company can get 6 times leverage, is very quickly shifted. And so pricing is a lot higher, I'd say, just to even start, and leverage has come down a good amount. And that's just across the board. So it's additive from the perspective of, we as lenders have more power. I think we're seeing a lot more rescue financing type asks, or more distressed debt type asks, where it's like, can you give us something with PIK? Is there some way we can solve for this? I think the areas where you're going to see the easy money, which is just the case, is a lot of like recession resilient businesses that may currently be closed because of a COVID type situation. So if it's an area where it's like a lower price retailer that generally does well in a recession because consumers trade down, but all their stores are closed, they're going to still need to pay debt. They're still going to need to do things, but there are scenarios there where you can look and say, hey, there's recession resilient business. In the back half of this COVID thing, you might want to pay attention to that. I think you're also seeing a couple of healthcare business pivot very quickly to telehealth. And I think we've seen some interesting opportunities there where, like, look, the next 3 to 6 months, they're going to be brutal because you're in this position of making this transition. But in the long run, I think telehealth will do really well. To your second question of like, what's kind of the long-term play here, I've started to just like take a step back from, to be honest, like a lot of this like investing or finance kind of views, and trying to just better understand what's going on. Like, I do think you'll see a lot more just general like government intervention. I do think you'll see a lot, I wouldn't call it Occupy Wall Street, but I do think you've got some like weird incentive structures where a CEO can take out a very large bonus in 2019 and say, hey, it's because I did a good job. And in 2020, he yells Black Swan, I couldn't foresee any of this, gets a bailout. I'm not saying it's the same as like an 08 bailout, but you can see how the public can see some similarities there. And I think you're going to just see a lot more like governmental action on this kind of thing, where some of the incentive alignment structures may not be as, optimal as they could be. And I think that's really going to impact a lot of how you're going to like be investing in things. I don't know what the outcome is there, but I think that's something you're going to have to watch a lot more of.
Yeah, one follow-up. I agree with you on the second point, and I also, on the first point, totally agree on the capital. One thing I wanted to hit on, you actually hit on this too. Like, obviously, there's one part of it which is just capital availability and pricing, but then there's obviously a huge component of operational, to your point, kind of what happens to these business models. We've been in this kind of 7-year cycle where maybe towards the end of it, even crappy businesses got a lot of funding, and you kind of got there.
Yeah.
What do you teams in terms of pipeline? And you hit on a couple areas like telemarketing, telehealth and things like that. But like, do you think though that other than some of these like high growth-ish areas, like operationally, a lot of these companies are run into issues? So do you worry then about, let's even if it's a consumer behavior shift, and you talk about retailers, do you worry though this could last more than 6 months and then the downside is more extended? Like they may go out of, they may go bankrupt, right? A lot of these companies.
Yeah, totally.
Yeah.
Like I think like there's a lot of fallout that's going to happen here. And I think the way you really understand this though is I would need to, go down and see some of my friends in Savannah and be like, actually going and like living that shared experience and like seeing what's happening is going to teach me way more of that than sitting behind the desk and trying to guess it.
At that point, is that at the end of the day, we've hit on this 3 different points here, but like, is that what makes your dollar greener or your investment higher IRR than another investor? Is just the kind of not just your ability to extract the motor out of the company, but is it your differentiated view on?
For borrowers, the differentiator is really coming in size. So we can write like $500 to $600 million checks. Obviously, we're not doing that right now, but we can hit it in big size, which is a differentiator. And then we can also be creative in our structures. Like there's times where we can do PIK, we can do mezzanine, we have our capital markets arm. So if you have a $1 billion deal, we can take down 500 and syndicate 500. So giving kind of a one size solution to be like, you've got a big deal. We've got, mezzanine pockets, direct lending pockets, a capital markets arm, and we can do the whole thing. And we can do, creative covenant structures and kind of figure it out in ways a bank can't. That's really the value add to the borrower. From an LP standpoint, I mean, look, like you look at all the biggest LPs, a lot of them are actually with multiple different shops. So there's a bit of a game there happening too.
On a private level. So that's fair. That's totally fair. Maybe let's spend the kind of the last few minutes here on just I would call it kind of advice in general topics, and we'll kind of go through a couple different areas here. Maybe, talk about advice for students, young professionals entering the job market or in the early part of their career in the current state of the world. What do you think, what do you want to tell those folks?
Yeah, it's going to be really hard. Like it's going to be really hard. And what I would say is like, take as many swings as you can. But you got to take swings. And if you can get even anything like an internship for the summer, kind of use that to your advantage to be like, look, I had this summer internship lined up. It got canceled, but like I didn't give up. I kind of was scrappy and had the grit to kind of figure it out and got something where I was able to just dive in and learn as best as I can. I think that's like a good way to go about doing it and just try to get something. I know not the same situation at all, but freshman year I had like Googled for like the 200 financial companies like closest to my zip code and just like called them all. Like you might literally need to resort to do that. Hopefully not. Like hopefully you can, do something else, but you might literally end up needing to do something like that. But so that's one thing. From a more longer term kind of perspective, what I would try to do is talk. So 2 things. One, talk to as many people as you can, because one thing that's very easy to tell quickly during an interview or even like an informational interview is, does this person know what they're talking about? And you want to just talk to enough people to know exactly what the job you're interviewing for is. I think the 3 really, if you can nail, so I'll say the 3 things that like I really look for, and I think a lot of people look for, and it can be roundabout ways and straightforward, is why do you want to do this specific job? Why do you want to do it at this specific firm? And why should we hire you? And if you can have really crisp answers to those 3 things that can't just be Control-C, Control-V over to the next firm, like you'll do really well. Like you don't want to be like, I want to do banking because it'll teach me modeling skills. And I want to do it at JP Morgan because JP Morgan's a great bank. And you should pick me because I go to a really good school. Like you can literally replace the name JP Morgan with Blackstone and do just fine. So you need to have like very specific answers for all of it. And that, and being tight and crisp on that will help you a lot. And now's a great opportunity to get tight and crisp on those answers.
Totally agree. And I think skill building, especially now, and I think we're all, it it really sucks what we're in, but kind of look at it as an opportunity because everyone's in that same boat. So kind of differentiating yourself there. What are types of skills do you think you recommend people, and this could be things you did, or maybe, you know, kind of as you alluded to this, kind of careers going forward, you know, what are the types of things that are going to be important in the finance world, or maybe even broader, that people need to build early on?
Yeah. So I think my view on this has changed over the past few years a little, but I think it's like a hands down, like EQ is the answer that I'd point to. When you're like 5 years out, let's call it 5, 6, you're in like, you know, getting to the end of that associate stage, trying to go up for VP. The truth is everyone's going to be able to model. Like if you don't have the technicals at that point, you're probably not going to be there. And then also after 5, 6 years, everyone's going to have some type of network. You don't work in the industry for 5 or 6 years and not know anybody. So everyone's going to be able to model. Everyone's going to be able to make memos, and everyone's going to be able to like have some network. You may not be like championing or bringing in all the deals. You're not like a rainmaker, but you're going to know some people somewhere. You probably know like someone at like most of the shops. So what's really going to set you out is, do people like and trust you? And can they trust you to run this business or run this portfolio company? And frankly, like, I don't want to sound preachy, but it's like, how do you make them feel? Like, or do they feel comfortable with you doing this stuff? And if you're going to be, and I probably spent too much time like in like library type settings in undergrad or anything. And if you're going to be the guy who's like too deep in the model and like, oh, like my deferred tax calculation is taking up all my time. Like, no. You don't want to be that guy. Like, it all has to be on the soft skills. It all has to be on your ability to sell. They need to feel comfortable putting you in front of an LP, a client. They need to be comfortable. Like, if they get COVID and don't show up for 2 weeks, like, you got to be able to run everything on your own. And that's way more on like EQ and your like life experiences. And so that's, I think, where I keep coming back to is like, you want to do as much as you can to just like see different things and like learn different things that are outside of your normal comfort zone. See how like other people are like, frankly, just like living, or other things that are happening outside, you know, not just from behind your desk. And that is something that I wish I had done more of earlier. And I think it's something that doesn't necessarily pay dividends day one, but come year 5, 6, 7, it's like the only differentiator you're really going to have, besides like a really rich uncle who can feature deals.
Right. I think you're absolutely right on. I totally agree. And that's something you learn over your career. Even more than that, I think it's the fact that is built every day as your reputation. You know what I mean? It's not like you show up one day and it's like, hey, I can take over this deal. It's like every single day the work that you put in, you know, people like notice that. So yeah. I think it totally is a process. A couple other things, like how were your interviews like for KKR? Like, where they kind of give people a get sense? Is it kind of, you know, there's obviously, you know, modeling, there's obviously fit, kind of what was your learnings from that whole private equity, you know, private investing process?
Yeah. So I had a few phone interviews first. That was a lot more. I think the phone interviews, like, you got to just hit it crisp on the head. Like, why do you want to do this role at this firm, and why should we pick you? If you can nail those really quickly in the first 10 minutes, you can actually work all of that into the walk me through your resume, tell me about yourself. You can nail those, like, that's all fine. Like, the phone interviews, usually from my experience, they're a little bit of fit, and then they'll have some like basic market or technical questions. But if you absolutely smoke the fit, or by smoke, I'm like positively, like you do a really good job, or you answered those 3 questions really well, they're not going to bother asking you like, so what's the yield on an 8% coupon bond trading at 90? Like, no, that's not even going to come up. They're just going to be like, let's bring them in. So I had like a few phone interviews, then I had like a day of in-person interviews, and then there was a modeling test. I would say the modeling test was probably the toughest. It was the most technical. Everything else was almost all like fit or market based, or just like back of the envelope math. But the modeling test was like, you know, you may have anywhere from 2 to 4 hours. They'll throw you in a room. They'll give you a computer with a data room and say like, fill out like a 10-page memo, model it, have a thesis, pitch, you know, what part of the cap structure do you want to invest in? And the important thing on that is just have an answer. Too many people don't have an answer. They're like, these are the good things, these are the bad things. It doesn't really matter what your answer is. You just want to say, pick one thing, say why, say the risks and mitigants, and say, you know, if you need to hedge yourself, you should hedge yourself by saying like, here's what I'd want further diligence, and just have that answer. And then after that, I had like a dinner.
That's perfect. I think the modeling test, to kind of what I refer to also as the case study, is exactly right. It's not that the technical part is actually challenging. It's like the whole thing, like putting together investment thesis, kind of highlights the downside, etc., understanding the business, all that stuff. Because frankly, the modeling is just one component of this whole like thing that you're trying to do. A couple more things. Just last couple things. Kind of as you think about what you've learned over your career, kind of how do you think, kind of dual question here again, like how do you think about like success, impact, and like finding the things that you talked about it earlier, building those experiences, seeing a lot of things, but how do you start thinking about that thing as your career evolves, and how do you measure success for yourself in terms of making an impact on at work?
Yeah, I think that's a good question, and the answer to that probably changes over time. So what I would say is when I say this as if I'm old, when I was younger, I was thinking, I used to think about success more in the lines of like an outcomes and like, hey, you hit this thing, you have some goal, you arrive at this goal, and like I've arrived, and then it's like on to the next one and on to the next one and on to the next one. I think over time I've probably changed and thought it's more of like a process. Um, and it's a lot more of like, you have to enjoy what you're doing, and you have to actually be okay regardless of the outcome, which seems really weird to say in like a high pressure finance type A environment, but I think it's one way to look at it for it to be more sustainable. So you have to actually enjoy the process and realize like you're going to lose out on a lot of things, and if you're always trying to like one up your past thing, at a certain point you know it's not going to be what you're thinking, and that feeling of, oh, I've arrived, I've made it, you won't actually get that. Like it'll keep moving, and then you're kind of a slave to your own like desires in a sense. I think the other thing that you kind of end up having to come through more is, you kind of have to give yourself to something a little bit, and I have found that I enjoy more when I feel like I am giving to something versus taking from something. Um, it's just made it a lot easier for me to think about what's like additive. So it can be anything, right? Like you can convince yourself however you want, but if you're constantly trying to like take money or like take some external thing and like throw it on the resume, like at a certain point that's going to run out. So
I like that. I actually like that a lot. I agree with you on both of those. And then also one other thing maybe I'd add to that is just like self-introspect. Kind of everything you're saying is actually a reflection of that, right? What are the things that actually you think, it's not the same for everyone. Everyone measures it differently. So what are the things that you find, intellectually, challenging, stimulating, and impactful? So I think that's great. Two last questions. One is, one question, and then I want to do just a quick lightning round. So on the question, is there any mistake that you've made over your career that you just kind of sit back and like, oh, I would have done this differently?
yeah, I just like stayed indoors too much. Um, and by that I mean like I probably stayed in the office longer than I had to be like, oh, I want to like know this modeling thing. Or I even after done it that work, I'd like go and like just like go home and like watch TV. And I think it would have been a lot better for me if I had like, well, like let me go spend some time in like a new bar. You should just try something different. Like go to a bar in Harlem, sit down and like talk to that guy for an hour. You might learn something. Like go do that a lot of different times and like ask people like, how did you end up here? Like you might be really surprised at like how someone ended up there in a very different situation than you, but like still in the same city. And like doing things like that will compound over time really, really well. And it's like that old Steve Jobs thing. Like you can't connect that dot from looking back. Like you got to just trust that like trying a bunch of different things, meeting a bunch of people, like just learning what's happening will eventually like add something for you. It's kind of like we were saying earlier, like how do you measure impact? Like if you really want to like help somebody or like give to something, like you need to like understand their experiences. And so what I would recommend you do is like, it's go try to learn what someone's going through who you don't spend time with, right? And like sometimes that's like the chef of your favorite restaurant. Sometimes that's like in New York, I think it's actually really easy. Like you can go to a lot of really cool, like the Cooper Hewitt, really cool museum. Like you can go do a lot of different things that you will never run into at Goldman Sachs. And like that's going to like open, like it's gonna like make you a broader thinker. That's gonna show you like, hey, there's more to life than like models and bottles, right? Like there's more
Yeah, no,
going on there, and 5-6 years down the road, like that shit's gonna compound.
I like it. So last thing we'll end with is just kind of rapid fire stuff. I have like just 4 or 5 things I wanted to ask you.
Yeah.
One is, okay, well, we'll start with this. We did this pre-recording, but any one or two favorite books, one professional and then maybe one more personal.
Yeah, so I'd point to Man's Search for Meaning by Viktor Frankl. And then I also like Guns, Germs, and Steel by Jared Diamond. I think those are both really good. I picked up reading this past year. I think like Henry Kravis is really big on it. And so there was like shoving like a reading list down people's throat. I read like 40 books this year. And like those were like, I think really, really good. Oh, another one I'd point to that was really good. I think it's just really good to like read these things. True American. Have you heard of that book?
No.
That was a really good one. So it's about true story. This Muslim guy in 2001, right after 9/11, he's running like his 7-Eleven shop, and a white supremacist walks in the door and shoots him in the head. And then the white supremacist walks out, like leaves. This guy survives. The white supremacist gets caught, and then the white supremacist gets the death penalty. And then lo and behold, the one guy who comes to be like, the death penalty is not fair, you need to overturn this, is the guy he shot.
Oh, wow.
And it's the whole story of like, why did that happen? And it's the whole process of like, oh, well, this white supremacist ends up being like, over the span of like 12 years, he's like, holy shit, I was a terrible person. And like, it's the whole process of like how the Muslim guys, like what he's thinking and how the white supremacists are thinking other things, like they end up meeting. It's a really good book. It's a true story.
No, I like it. I picked it up. So that was on KKR's list of books to read this year, I guess is what you're saying?
That one wasn't.
Okay.
I kind of just found that one. But in general, I think KKR sends around like a couple people do this thing or like here, like some good books. And then I know there was a principal I worked with who sent a book list last year as like some lessons from like books he had learned. And I was like, I should do that.
I love it. I ask all the folks this because I do learn a lot, and these are actually really good ideas. Daily publications, weekly publications that you like reading, that you recommend.
I don't really read as much news anymore. Like I'm on Bloomberg frequently. I think some good ones to read, some additive things. So Matt Levine is a Bloomberg journalist who I really like. He puts out a daily take that's free, and I think it's one of the best things. It's one of the only things I read consistently in terms of news. That's not sensationalized and like I think it teaches especially college students a lot. He's like a former Harvard valedictorian that went on to be a Catholic school teacher, and he was like, this is dumb. And then so he decided to go to like Yale Law School, and then he did M&A law at Sullivan, and then he was at Goldman for a bunch of years. And then he was like, I hate all of this, I'm gonna go write. And so he's, in my opinion, one of the journalists who has real experience in terms of what he's actually writing about. And he writes free blog, and he's a really famous like awesome guy, and if you email him, he'll totally respond.
Oh, wow.
And he'll be
okay.
He's really good. That's one thing I'd point to. And I think another thing that's really helpful, it's not daily, but a lot of the PMs and CIOs of companies put out like their investment letters. So like Bill Gross has like a monthly investment outlook since like 1990. I read all of that when I was in college, and don't get me wrong, like I didn't need to do that. It's kind of a waste of time. But it did help me in terms of like setting context and gaining the linguistics for talking about like markets with historical context. And so you don't need to like read all of them, but reading some of the Bill Gross investment outlooks, reading some of the Howard Marks outlooks, you're probably actually going to learn a lot more from that than just like reading the news.
Maybe pick one deal that you're super proud of and kind of the impact that you made, and just kind of maybe talk about it a little bit just to give a flavor for it. You can anonymize it. That's fine.
Yeah, I mean, so one thing that was like very cool. This is probably like one of my favorite days at KKR. Actually, it was an out of court restructuring for a deal, and it was like a live negotiation. So I think this is the stuff that like you kind of live for, and I felt like I was on Suits because we walked into Paul Weiss's office at like noon, and we were in like let's call it the first lien debt, and then the second lien lenders came in through, and we're all sitting on like the 50th floor, like all across like a huge round table, and we're about to negotiate like who's taking over this business. And it's very much like we put our offer that's like this company's going into bankruptcy at some level, like do you want how much money, what are we willing to give the second lien as first lien lenders, like what equity can you take, what equity can we take? And so we put an offer out there. they go into their side room, they come back, they give their counter offer, they go away, and then we have to like model that out like live and be like, okay, well, what does that mean? What does that mean for our equity returns? Like, what if the company's worth like 3 billion? What if it's worth 1 billion? Like, what does that mean in terms of all of the different outcomes? And like, you have to do all of that live, right? So there's no time to be like, I need to get my like deferred tax calculation right. No, like you need to have a very quick model where you can put out an answer in less than 15 seconds. And like all of that needs to be like perfect. And you need to put all of that out live. You need to say that stuff. And then, they'll come back and you give them your response, and you just go back and forth like that for like 4 or 5 hours. And you negotiate different points that are important to you. And at the end, you like come to this resolution. It's like, okay, now we're actually going to be partners. We're going to own X%, you're going to own Y%. We had to do like an ad hoc investment committee in that. So like after like 3 rounds of negotiations, we have to like call up the partner of our firm and be like, hey, like this is where it's shaken out. Like, do we do it? And he's going to be like, do this. And then you're okay, go back. And like, it's a very live, rapid fire negotiation process. And you got to have everything right on your modeling and have a good understanding of like what you're negotiating about, which was like a cool experience.
That's amazing. I love that, because I think 2 things there. One is it's kind of why we do all these jobs, right? It's kind of you kind of get in that room and kind of make things happen, right? At the end of the day. So that's one thing. The second thing, there's really no one really sees all the work that you did the night before, the night before, the night before. You built the flexibility in the model, that you're there. I think when things are going, you're prepared and you're ready. You have this like amazing amount of power in kind of doing it, but there's so much work that goes out in terms of thoughtfulness and stuff. So that's really cool. I had a similar experience at GS when we presented to the management committee. It was a partner and me, I was a senior associate. Same exact thing. Was like Gary, David, all these guys, Rich Friedman, all these guys in the room. And it was like one of the scariest things in my life. But at the end of the day, I was like, wow, this is really cool. That's awesome. Cool. And then last thing, given the conversation has gone, any general career advice, for people or maybe yourself 5 years ago, what would you tell yourself?
But I think it would be 2 things, and they like sound counter. They sound like they counter each other, but I think it'll make sense. The first thing is to read a lot of things that are not about like finance and econ and like making money on Wall Street and like a lot of business and like self-help. Like put all of that aside and just like read other stuff. Like you can read history, you can read like like nonfiction, you can read like there's just a host of things you can read, and like go read that stuff. There's a lot of good things you can learn out there, and it'll make you more well-rounded. And then the other thing is like, if you can have a habit of reading, like you don't want to sit in your room and like read all day. Like if you're reading 30 minutes a day, that's probably pretty good. And then the other thing is like get out more. Like just get out more and like go see what everything is out there. Like doing things like that will compound a lot more and make you a better investor, more than like knowing how to model. There's just a lot of scenarios where like very wealthy people aren't necessarily in touch with consumers, and you see scenarios where people are like, why does this business exist? Like, why does it happen? It's like, oh, like, well, the consumer for this business is somebody else, and here's why they're always going to buy it. And I mean, I've kind of anonymized there, but like, it's really hard to sometimes make that connection if you haven't seen it yourself.
So we'll end the podcast here. Thanks so much for joining us. I think this is extremely enlightening. We've covered a lot of topics. Hey guys, welcome back to the latest edition of Elevate Career Academy podcast. Today, I'm super excited to feature a conversation with our guest who works at KKR, one of the largest and most prominent private equity funds in the world. Prior to that, he started his career at Goldman Sachs on the distressed credit side. Today's discussion is really going to focus a lot on private investing and also credit, debt, and investing. It's a great area to learn about, especially in these times, and really insightful for anyone who's interested in private investing, credit, and really how deals come together. We talk about a range of different topics, right? And here are some highlights. First, what is the role of an associate or principal at KKR? Specifically, what are the types of modeling, analyses, and work that you're doing? What types of work do you do on a day-to-day basis? And how do you think about risk protection downside on the deals that you work on? And more broadly, how does one become a better investor in that context? We also spent time on how he entered his finance career from a non-target school into Goldman Sachs. In fact, he didn't get an interview at Goldman at first, but somehow he got creative to land that job. We go into the differences between public and private investing and the types of people that are, from his experience, successful in one or the other. We also spend some time on how you can use your early career experiences, whether it's internships or jobs, to find out what you're really good at and interested in, and things that you're not good at or maybe less interested in, and that really forms how successful you can be early on in your career. We talk about the current markets, what's going on in the deal space, leverage, credit, transactions, um, and 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 how that's being impacted by what's going on around the world. We also take a short-term, medium-term, and long-term view. I also spend some time on how Corona is going to affect deals and companies and businesses going forward. Then we touch on advice, tangible advice that we can give and he can give to students and young professionals. And the general takeaway is, look, it's going to be tough, um, but kind of focusing on building skills and really setting yourself for success for your career is going to be really important. One of my favorite parts of this whole conversation is when he goes into his favorite deal experience at KKR, and it kind of feels like a behind the scenes to like a Suits episode. So I think you guys really enjoy that. So overall, I'm really excited to bring you guys this conversation. Check out this and all of our other amazing resources at elevatelab.org. And we're now on Instagram and LinkedIn too. So the links are below. And if you really, if you like our content, subscribe and share with others. All right, so now let's get to it. Thanks for listening.